Hey folks, I hope you're doing fine. I'm Simo from Investment Research, and today I'm going to show you one of the most powerful yet underappreciated strategies for building your first $100,000 in the stock market. We're talking about dividend growth investing, and this is not your typical get-rich-quick scheme. This is about building real sustainable wealth that compounds over time while putting cash in your pocket every single quarter. Before we get into specific stocks, let me explain why dividend growth investing is so powerful. The beauty of this strategy is threefold. First, you're getting paid to own quality companies through regular dividend payments. Second, these companies are actually increasing those payments every single year, which means you're getting raises without doing anything. And third, you can reinvest those dividends to buy more shares, creating a compounding machine that accelerates your wealth building over time. Warren Buffett himself said that his favorite holding period is forever, and most of his wealth came from owning dividend-paying companies like Coca-Cola for decades. Let me break down the math because this is where it gets exciting. If you invest $10,000 in a dividend stock yielding 3% that grows its dividend by 7% annually, and you reinvest all dividends, in 20 years you'll have approximately $40,000. At that point, your dividend income alone would be over $1,200 per year, and it keeps growing. Now imagine doing this with multiple stocks across a diversified portfolio. The numbers start getting very attractive very quickly. So what separates a good dividend stock from a great dividend growth stock? You need to look beyond just the current yield. The highest yields are often traps, companies in declining industries paying unsustainable dividends. What you want are companies with three critical characteristics. First, a long track record of raising dividends, ideally 10 years or more. Second, a reasonable payout ratio, typically below 70%, which means they have room to grow it. And third, strong free cash flow generation and competitive advantages that ensure the business can sustain dividends for decades. Let me introduce you to two elite categories. Dividend aristocrats are companies in the S&P 500 that have increased dividends for at least 25 consecutive years. These companies raised dividends through 2008, the dot-com bubble, the pandemic, and every recession. There are currently 69 of these companies. Even more elite are dividend kings, companies that have raised dividends for at least 50 consecutive years. There are only 55 of these in existence, and owning them is like owning a piece of American economic history. Now let me walk you through 5 specific dividend growth stocks that should be core holdings for building your first $100,000. First is Johnson & Johnson, ticker JNJ. This is a dividend king with 62 to 63 consecutive years of dividend increases. The company is a global healthcare behemoth covering pharmaceuticals, medical devices, and consumer health products. The current dividend yield is approximately 2.7% with a quarterly payout of $1.30 per share. The payout ratio is around 53%, which gives them enormous room to continue growing the dividend. Healthcare demand doesn't disappear during recessions, making this incredibly resilient. The company reported Q3 2025 revenue of $22.5 billion, up 5.4%, with strong growth in pharmaceuticals driven by oncology and immunology drugs. Analyst price targets suggest the stock could reach $227 by 2030. My view is this is a core holding that you buy and never sell. It's not going to make you rich overnight, but it will pay you reliably every quarter and compound your wealth over decades. For someone building their first $100,000, J&J should represent 10% to 15% of your portfolio. Second is Procter & Gamble, ticker PG. This is another dividend king with 68 consecutive years of dividend increases. The company makes consumer products you use every day: Tide, Pampers, Charmin, Gillette, Crest, and dozens of other brands. These are not discretionary purchases, these are staples people buy regardless of the economy. The current dividend yield is approximately 2.6% to 2.8%, and the company just raised its dividend by 7% from $0.9407 to $1.0065 per quarter. The company has beaten analyst estimates in 26 of the last 28 quarters, showing incredible consistency. For Q1 fiscal 2025, they reaffirmed guidance for 3% to 5% organic sales growth and 5% to 7% EPS growth. What I love about PG is the pricing power. When inflation hits, Procter & Gamble can raise prices because consumers won't stop buying toothpaste or toilet paper. This pricing power protects the dividend and ensures continued growth. Procter & Gamble should be another 10% to 15% position in your portfolio. It's boring, but boring wins in dividend investing. Third is Coca-Cola, ticker KO, Warren Buffett's favorite dividend stock and another dividend king with 63 years of consecutive increases. The world's largest beverage company with over 200 brands sold in more than 200 countries. The current dividend yield is approximately 2.9% to 3.0%. Coca-Cola operates on a franchise distribution system, producing syrup concentrate and selling it to licensed bottlers. This asset-light model generates enormous free cash flow. The Coca-Cola brand is worth tens of billions and is recognized globally, giving the company pricing power and customer loyalty competitors cannot replicate. The company recently beat Q3 earnings expectations despite a tough macro backdrop. Management has been diversifying into water, juice, sports drinks, and reduced sugar options to maintain growth. The 3-year dividend growth rate is 4.9%, which is steady and sustainable. I would allocate 10% to 12% of your dividend growth portfolio to KO. It's another sleep well at night holding that will pay you reliably and grow that payment year after year. Fourth is ExxonMobil, ticker XOMA Dividend, aristocrat with 43 consecutive years of dividend increases, which means they raised dividends through multiple oil crashes and the pandemic. The current dividend yield is approximately 3.4% to 3.5%, with the latest quarterly dividend at 99 cents per share. What's remarkable is they maintained and grew their dividend even during 2020, when oil prices briefly went negative. The company is one of the world's largest integrated energy companies, with operations from exploration and production to refining and chemicals. This integrated model means they make money across different parts of the value chain, providing stability. ExxonMobil generates enormous free cash flow that supports the dividend, funds growth projects, and allows for share buybacks. The company is also investing in lower carbon energy solutions while maintaining its core profitable businesses. My recommendation is to allocate 8% to 10% to XOM. This gives you energy sector exposure, which provides diversification and performs well during inflationary periods. Plus, that 3.5% yield is attractive, and the track record through oil crashes gives me confidence. Fifth is Realty Income, known as the monthly dividend company, because they pay dividends 12 times per year instead of 4. Since going public in 1994, Realty Income has produced a compound annual return of 13.5%. The current dividend yield is approximately 5.6% to 6.0%, which is significantly higher than the other stocks we've discussed. The company has increased dividends for over 100 consecutive quarters. Realty Income owns over 15,000 commercial properties leased to retail and industrial tenants like Walgreens, 7-Eleven, Dollar General, and FedEx under long-term net lease agreements. The net lease structure means tenants pay property taxes, insurance, and maintenance, so Realty Income collects rent with minimal expenses. This creates stable, predictable cash flows that fund the dividend. The portfolio is highly diversified across hundreds of tenants, reducing concentration risk. The monthly dividend structure is incredibly attractive for building income streams. My recommendation is to allocate 10% to 15% to Realty Income. This gives you real estate exposure, monthly income, and a higher current yield that can be reinvested. So there you have it, 5 dividend growth stocks that should form the core of your portfolio as you build toward your first $100,000. Johnson & Johnson at 10% to 15%, Procter & Gamble at 10% to 15%, Coca-Cola at 10% to 12%, ExxonMobil at 8% to 10%, and Realty Income at 10% to 15%. That's approximately 50% to 65% of your portfolio in these 5 core holdings. Now, let me talk about execution, because knowing which stocks to buy is only half the battle. The real power comes from consistency and reinvestment. Set up automatic investments into these positions, whether it's $500 per month or $1,000 per month. Dollar cost averaging removes emotion and timing risk from investing. Most importantly, reinvest all dividends automatically through a DRIP or dividend reinvestment plan. This allows you to buy fractional shares with your dividend payments, compounding your wealth faster. Let me show you what this looks like in practice. If you invest $500 per month into this 5-stock portfolio, averaging a 3% current yield and 6% dividend growth with stock appreciation of 7% annually, in 15 years, you'll have approximately $180,000. You'll have blown past your $100,000 goal and built a portfolio generating thousands in annual dividend income. The key is starting now and staying consistent. Time in the market beats timing the market, especially with dividend growth investing. The risks to understand are that during bear markets, even dividend aristocrats will decline in price. However, if the dividend is maintained, you're actually buying more shares at lower prices, which accelerates your long-term returns. Additionally, some companies may cut dividends during severe crises, though the aristocrats and kings have proven incredibly resilient. Diversification across the 5 stocks I mentioned helps mitigate single company risk. My final thoughts are that dividend growth investing is not sexy. It's not going to make you a millionaire overnight, and you won't have exciting stories to tell at parties. But it works, and it works consistently over decades. These 5 stocks represent quality businesses with durable competitive advantages, strong management teams, and commitment to shareholder returns. They're the foundation for building your first $100,000 and beyond. Start small if you need to, but start today. Set up automatic investments, reinvest your dividends, and let compounding do the heavy lifting. That's my analysis on building your first $100,000 through dividend growth investing. As always, do your own research, understand your risk tolerance, and stay consistent with your investment plan. Thanks for watching, and I'll see you in the next analysis.